The very last thing I'll ever do is investing without a plan. That's simply like driving a car blindfolded. It's just not a good idea. In this video, I'm going to be writing my investing plan for 2026. I have linked a copy of the template below for you to download so you can follow along. So the very first thing you want to do is to identify what your financial goals are. So I'm going to share my screen now so you can see exactly how I'm going to write mine. So the first thing you want to write is what the financial goal is. For example, I'm going to write invest for a new car. So now we know what we're investing for. The next thing is to try find out exactly what financial foundations we need for this to happen. Okay, so what's the money for? We need the money for investing for a new car. We've said that. So with this one, you want to think life first rather than the products. So you don't want to write something like, I want to fill up my ISA, or I want bare money in the bank, something like that. Instead, you want to think, okay, I want to invest for retirement, let's say, or I want to invest for a deposit on a house. That will then allow you to figure out exactly what the money is for and how to achieve that goal. So first of all, you want to write, what is the money for? The first thing you want to write there is invest for a car in 2026. It's very important you then attach a time frame to it. I'm going to put by 31st December 2026. So how much do I need? So I'm going to put £10,000, let's say. Okay, so nice and simple. So now I know I want to invest for a car. I want to have that car by the end of 2026, and my target is £10,000. And I'm not mentioning anything about crypto or stocks or bonds. I'm not writing anything like that. I'm just identifying what foundations I need to lay. Okay, now how am I going to raise £10,000 within the 12 months? I'm going to invest £850 per month. So the next thing we're going to move on to is how we're going to invest that money and what we're going to use to achieve those goals. You've got options such as ISAs, you've got pensions, you've got general accounts, high yield savings accounts, and so on and so forth. Because it's something relatively short term, so we're talking a 12-month program, you want to put something that's not going to expose you to too much risk. So in this case, I'm going to use my cash ISA, so you can leverage the stock market, or you might want to do something like crypto. So this is where you define that. So for me, because it's a relatively short period of time, it's a relatively small amount of money, so I don't really want to expose myself to too much risk. So I want something like a cash ISA, which is safe. It means that there's not going to be any volatility. I don't want my money going up and down, especially towards when it's time to actually buy the property, the car. That's where you identify the goal versus the risk. So it's going to be a low risk wrapper, and I don't want to expose my investment to any market volatility. Right, so the next step for this is to actually write a one-page financial plan. Okay, so I'm going to write, I will invest at least £850 per month in order to purchase a car by the 31st of December 2026. I will do so by getting a part-time job that will supplement my current income, and I'm going to work at least 20 additional hours on an evening and on weekends. Okay, so we're talking maybe additional 5 hours per day during the week, or maybe you could do longer on weekends. So you might do maybe a 10-hour shift on the weekend and then do a few hours through the week. Now, once I get the money, I'm going to invest that in the cash ISA because it's safe, it's tax-free, and it's guaranteed returns. And finally, I'm going to type in when I'm going to review it. So it's important to review your plan. So some people would review it, say, monthly, quarterly, annually. So for the sake of this one, I'm going to review it monthly. Right, so let's look at investing for retirement. So what's the money for? I'm going to type in to retire comfortably. And what's the time frame? So I'm going to say 30 years, let's say. Long term is regarded 10 years plus. How much do I want to aim for? How much money? So if you were to do the maths, if I wanted, say, £50,000 to live off, and I plan on living for say 30 years, let's say. So from retirement age of say 68, let's say 20 years. Okay, so you go 50,000 times the 20 years that you want to live off. So that's £1 million. So I'll type in £1 million. Okay, now we need to think, what instruments are we going to use to achieve this? Because it's longer term, we have more time for volatility. We can recover from market drops and so on and so forth, and we want to do something that's going to be regular. So we don't want to necessarily put in £1 million, even if we have it. Would you really want to put that in one go? So first instrument I'm going to think about is my workplace pension, and it is also tax efficient. Obviously, with the workplace pension, wherever you play into it, your employer will also match it. If that option is available, make sure you maximize that as much as possible. The goal is going to be long term, and the risk can be medium to high. So for that reason, I'm going to include stocks and bonds, dividend paying ETFs. Okay, and I'm going to write my one-page financial plan now. I will invest at least £100 per month in my workplace pension, with my employer contributing towards. I will also invest at least £100 per month in my self-invested pension, my SIP, using a broad market index. So we're talking something like the S&P 500 or a world index, or something that tracks some sort of fund. That way you're not taking excessive risk, but you can expect decent amount of growth. I will review this on a quarterly basis, and then I will invest at least £100 per month in the stock market using my stocks and shares ISAs. So as you can see, this is very different from when you're investing for a short-term plan like buying a car. With this, you're looking at regular contributions, you're looking at a longer time frame, you're using things like the SIP and the workplace pension to take advantage of the tax efficiency, also the contribution from the government and from your employer. And we're then going to take a slightly bigger risk using the stocks and shares ISA, which is still tax efficient, but that opens up the opportunity to invest in things like individual stocks or dividend paying ETFs and so on and so forth. Now, because it's a longer term thing, you don't need to necessarily review that on a monthly basis, so you can just review it on a quarterly basis. I hope that's helped someone. You need to pay attention to a few of these common mistakes that people make. The very first one is to try make one portfolio for every goal. It doesn't make sense, as I've just explained to you. You know, you need to marry what your goals are versus the tools versus the risk, and also how you're going to execute that. The second thing is that a lot of people go around chasing returns without a purpose. You know, I just want to invest in crypto, I just want to invest in gold, but there's no reason for it. They just want to do it just because maybe they heard that crypto's done well last year, or maybe because they hear that, you know, the S&P is where you need to be investing. They don't have the purpose. Another thing that I see a lot of people doing is just simply copying others just for the sake of it. You know, my friend at work is invested in this, so I'm going to invest in it also. But why? Do you know the reason he's doing that? Do you know why your friend is invested in something other than the other? You're just doing it just to copy. Also, a big one is people setting goals without timelines. So I want to achieve financial independence. Okay, within what time frame? At what age? I want to save for my first home, the deposit on my first home. Right, how long are you going to set that for? Is that a 1 year project? Is it going to be 2 years, 5 years? How long is it going to take you to raise that kind of money? And you also have to make sure you write down those plans. You need to put it all in writing so you can see it there. You can actually analyze it, you can go over it, you can review it, you can tweak it. You can't do that if it's just in your head, so you need it actually in writing. So we're going to have a quick recap then. So first of all, you want to set your goals. You need to make sure the goals are based on life outcomes rather than the products. So it's not I want to fill up my ISA, it's I want to invest for retirement, I want to invest for a new car, I want to invest for starting a new family. Then you want to assign the time horizon. So you want to say within 12 months I want to have money for my car, within 5 years I want to have a deposit on my home, within the next 2 years I want to have money to get married and start preparing to have children and raising a family. You then need to put rough numbers. You don't have to be precise, but if you know your car is going to cost you £10,000, then you can put £10,000. Or if you know you want to buy a property and it's going to cost you, I don't know, £350,000, you can put that. But if it's something like retirement, you can just work out roughly what you want to retire on. So, I don't know, £20,000 per year, tax free, and then you want to put that for 20 years. So you do £20,000 times the 20 years, 400,000 as an example. Then you want to match the goals to the risk. If you're investing for the long term, then you can take more risk because that allows your investment to recover. If you're investing for 12 months, 3 months, 2 months, then you might not want to take as much risk. So you want to use something that's a little bit safer and doesn't expose you to the volatility of the market. And that's where you then have to choose the correct wrapper and the correct tool. So do you want to use a SIP, bearing in mind that anything to do with pension, there are restrictions on when you can gain access to it. You want to build some flexibility in there because, like I said, things do change. The market can drop, you might earn less money, you might lose your job for a period of time. You need to build yourself some flexibility. So if you notice, some of the languages I put there was, I'm going to invest at least £100. It means that some months I might be able to put £500, let's say, and some months maybe I can't quite put £100. It's okay because I've overinvested in other months, for example. And like I said, make sure you write it down. So I'm curious now that you've seen how I've written my own plan for 2026, I'm going to link it below, but I want you to tell me what your first goal for 2026 is. I want you to write it in the comments below using 5 words only. So for example, I want to invest for retirement, or I want to invest for a new car. Just put it in the comments below. I'm going to be checking them all and I'm going to compare what everyone writes. And make sure you like, make sure you subscribe, make sure you share this. This might help somebody, and let's all start the year as we aim to go on. It's Roadman Investor. Join me next time.